Have you ever wondered how economic downturns shape the world we live in? Economic downturns, although dreaded, are inevitable periods of economic contraction that have significant impacts on society. These periods of economic decline have a profound ability to alter the course of history, leaving behind a unique legacy each time. Let's start with employment. When the economy takes a nosedive, companies often find themselves in a tight spot. They may need to lay off employees to cut costs, leading to an increase in unemployment rates. This, in turn, reduces consumer spending, as people tighten their belts to make ends meet. The ripple effect of this can be felt throughout the economy, leading to a further contraction. Next, we have housing. During an economic downturn, the housing market often suffers. As people lose their jobs, they may struggle to keep up with mortgage payments, leading to increased foreclosures. The increased supply of houses on the market, coupled with a decrease in demand, can cause house prices to plummet. This can result in a housing market crash, which can further exacerbate the economic downturn. Finally, let's talk about the stock market. The stock market is often seen as a barometer of the economy's health. When an economic downturn hits, investors may lose confidence and start selling their stocks. This can lead to a stock market crash, which can wipe out billions of dollars in wealth in a short period. But it's not all doom and gloom. Economic downturns, while challenging, can also provide opportunities. They can lead to structural changes in the economy, paving the way for new industries and innovations. They can force businesses to become more efficient and competitive. And for those who are prepared, they can present potential investment opportunities. As we delve into the history of U.S. economic downturns, we will see how each one has left a unique imprint on the nation. From the Great Depression to the recent Great Recession, each downturn has shaped the U.S. in its own way. So, buckle up as we journey through the ebbs and flows of the U.S. economy. The most infamous economic downturn in U.S. history is undoubtedly the Great Depression. The Roaring '20s were a time of prosperity and growth, but it all came crashing down on that fateful day in October 1929, known as Black Tuesday. That's when the stock market took a nosedive, marking the beginning of the Great Depression. Now, this wasn't the sole cause, but it was a significant trigger. The economy was like a house of cards, and the stock market crash was the gust of wind that toppled it over. Let's rewind a bit. The decade leading up to the crash saw a speculative bubble in the stock market. People were buying stocks on margin, essentially borrowing money to invest. This worked well when stocks were on the rise, but when they started to fall, it led to a domino effect. Investors couldn't meet their margin calls, which led to more selling and a further drop in prices. But the stock market crash alone didn't cause the Great Depression. It was also compounded by banking panics. As the banks faced runs, they began to fail. And with no federal deposit insurance, once a bank failed, people lost their savings. This led to a contraction in credit and a decrease in spending, further deepening the economic downturn. Policy mistakes also played a part. The Federal Reserve, in an attempt to stem speculation, tightened monetary policy, which only served to exacerbate the situation. The Smoot-Hawley Tariff Act, aiming to protect domestic industries, ended up shrinking international trade and worsening the economic slump. The effects of the Great Depression were profound and far-reaching. Unemployment skyrocketed, with 1 in 4 Americans out of work at the height of the Depression. Widespread poverty and despair were the norm. The breadlines and soup kitchens became symbols of the era. The Depression also led to significant changes in economic policy and spurred the creation of safety net programs, many of which are still in place today. The Great Depression left an indelible mark on the United States, influencing economic policy for decades. Moving forward in history, we encounter the economic downturn of the 1970s, characterized by stagflation. This period was unlike any other, as it was marked by two economic conditions that economists had thought couldn't occur simultaneously: stagnant economic growth and rampant inflation. The 1970s stagflation had its roots in a few key factors. One of the primary culprits was the 1973 oil embargo by OPEC, the Organization of Petroleum Exporting Countries. This embargo caused a sharp increase in oil prices, which in turn led to a surge in inflation. Suddenly, everything from manufacturing to transportation became more expensive, causing the cost of living to skyrocket. But it wasn't just about oil. Poor monetary policy also played a significant role. The Federal Reserve, under the leadership of Arthur Burns, pursued a policy of low interest rates in an attempt to stimulate economic growth. However, this ended up fueling inflation instead. The combination of these factors led to the unusual situation of stagflation, where the economy was not growing, yet prices were rising rapidly. This had a knock-on effect on the job market, leading to high unemployment rates. It was a tough time for the American people who faced job insecurity and a high cost of living. In response to this economic crisis, policymakers had to rethink their strategies. The old economic playbook, which suggested that there was a trade-off between unemployment and inflation, seemed to no longer apply. New economic theories emerged, and policymakers started focusing more on controlling inflation, even at the risk of higher unemployment. The 1970s stagflation was a pivotal moment in American economic history. It challenged existing economic theories and forced a shift in monetary policy. It was a difficult period, but it also led to important lessons and changes that continue to shape economic policy today. The 1970s, stagflation tested the resilience of the American economy, leading to significant policy changes. The most recent economic downturn, the Great Recession, still looms large in our collective memory. The roots of this economic shakeup can be traced back to the housing bubble of the early 2000s. A period of easy credit and speculative real estate investing created an unsustainable boom in housing prices. But like all bubbles, this one was destined to burst. And when it did, it triggered a chain reaction that led to the most severe financial crisis since the Great Depression. Banks and financial institutions heavily invested in the housing market found themselves on shaky ground as mortgage defaults soared. Some of the biggest names in the banking industry either collapsed or had to be bailed out by the government. But the effects of the Great Recession weren't confined to Wall Street. They reverberated throughout the economy, leading to widespread job loss and home foreclosures. Millions of Americans found themselves out of work, their dreams of homeownership shattered. The unemployment rate soared to 10%, the highest it had been since the early 1980s. The stock market also took a hit, with the Dow Jones Industrial Average plummeting by more than 50% from its peak in October 2007 to its nadir in March 2009. Retirement savings evaporated, businesses shuttered, and a sense of economic insecurity gripped the nation. In the aftermath of the Great Recession, policymakers grappled with how to prevent such a crisis from happening again. The result was a raft of new financial regulations, including the Dodd-Frank Wall Street Reform and Consumer Protection Act. These laws aim to increase transparency in the financial industry, limit risky lending practices, and provide better protections for consumers. Yet, despite these measures, the scars of the Great Recession remain. Many Americans are still recovering from the financial hit they took during those years. And the lessons of that time continue to inform our approach to economic policy and personal financial management. The Great Recession reinforced the importance of robust financial regulations to prevent future economic downturns. But it also underscored the reality that economic downturns are, unfortunately, a part of the economic cycle. The challenge is to learn from these experiences so we can better navigate the economic storms when they inevitably come. As we have seen, economic downturns can have profound effects on society. From the Great Depression of the late 20s to the 30s, with its severe worldwide economic impact, to the 70s stagflation, where inflation and unemployment coexisted, each downturn has its unique causes and effects. And who can forget the Great Recession just a decade and a half ago, triggered by a financial crisis and resulting in significant job losses? The common thread among these downturns is the cyclical nature of the economy. Economic activity ebbs and flows, sometimes reaching peaks of growth, other times plunging into valleys of recession. These cycles are influenced by a myriad of factors, including financial markets, government policy, and global events. However, as daunting as these downturns may seem, they also present opportunities. Economic downturns can spur innovation, prompt policy reform, and lead to greater financial resilience. By understanding these historical economic downturns, we can better prepare for and perhaps even prevent future economic crises.